Hello and welcome to Lecture 6 of the Fiat Standard. Today's lecture is based on Chapter 6 of the Fiat Standard and it is entitled, What is Fiat Good For? So, in today's lecture, we are going to look at the three benefits of the implementation of Fiat technology. And in the Bitcoin Standard, I had a chapter where I explained what are the benefits of using Bitcoin. In this book, I'm going to try and explain from a technological perspective, what are the benefits of using fiat? I mean, surely there must be something that is useful about this technology for it to be used all over the world. So what are the advantages of it? What does it really offer? I can classify the benefits of fiat into three. The first is that it allows for government finance. It allows for the government to finance itself. And I discussed this extensively in Chapter 3 of this book, as well as Chapters 6 and 7 of the Bitcoin Standard. So I'm not going to discuss them here. But if you've read the Bitcoin Standard and if you've read Chapter 3 of the Fiat Standard, you should get a very good idea about why I think fiat allows government finance to increase enormously, because it effectively allows them to spend first and then give the bill to people later in the form of inflation and price rises. Putting that aside, clearly governments are very happy with fiat. What else does fiat offer? I think the real technological and technical capability that fiat introduces is its salability across space. Your ability to send fiat across space is really unrivaled when you compare it to all the pre-Bitcoin technologies. With everything that is physical, if you had to move something that's physical, it's pretty expensive to move it around. You need to put it on a donkey or a horse or a camel or a train or a ship. And so all forms of physical money become less and less practical as global trade becomes more and more global and more extensive, and because the money can't keep up because it's too expensive to move the money, whereas credit is very cheap to move around because it's just information. You just need to say, this person owes that person that much. And then as long as you just communicate the information to all parties, then you can effectively move the credit and the liabilities and the fiat money pretty easily. And third is bank profitability. Fiat is specifically optimized for making banks profitable. So those are the two things that we're going to be discussing in this chapter: salability across space and bank profitability. So we begin with salability across space. This is based on the work of Menger, really the father of the Austrian School of Economics. And Menger said, money is the most saleable good. And that's the definition of money. And I think it's the most coherent definition of what money is. It's a medium of exchange, and the medium of exchange ends up being the most saleable good, the good that is the most easy to get exchanged on the market at any time that you want to exchange it, where you are likely to suffer the least slippage in terms of the cost. So salability then is a function of the spread between the bid and the ask for an asset. This is a good way of understanding it. So goods that are extremely saleable will have a very small spread between buying and selling, because there are a lot of buyers and a lot of sellers. The market is extremely competitive and there are constantly transactions happening. And so people can always find somebody that is willing to buy, and therefore, because of that, not always, but the more likely you are to find counterparties to the market, to your trade, the more likely you are to be able to get a lower spread on the price. The price is going to concentrate between a bid and an ask that are not very large in their spread between each other, because all of the people buying and selling are exchanging with each other and they're providing liquidity for the market. The more liquidity there is, the more likely you are to find somebody who wants the exact same thing that you want to buy and who wants to sell and who wants to buy the same exact thing that you want to sell. So the more the liquidity, the more likely you are to have a very fluid market and a very liquid market in which the spread between the bid and ask is very low. On the other hand, if you had the opposite situation where you have a good that is not very easy to spread, that is not very easy to sell, you have an intermittent amount of people buying and selling this particular good. Imagine if you have a house and you're trying to sell a house, it's not as easy to sell a house as it is to sell a $100 bill. It's not as easy because the house requires a specific person who needs this exact kind of house in this location with this kind of size and these amenities and all of the details of your house. It's a very specific demographic that is looking for this particular house. So it's not very easy to find somebody who's going to just pick it up very quickly. And so we have, we have in every market, obviously, there is a bid and an ask. And the bid is the maximum price that a buyer is willing to pay, whereas the ask is the minimum price that a seller is willing to accept. So you, as a seller, there is a price that you're willing to accept. And the buyer, there's a price that they're willing to pay. And usually, the trade happens between those two. Now, the more liquid the market is, the more that these two get pushed together, the less the spread happens there, so that people know exactly what the value of this one particular thing. It's a very liquid good. It's a fungible good. It's all the different types of the good are exchangeable for one another. And so therefore, you can get this good exchanged very quickly on the market. Because of that, the price range is very well known to all market participants. That's, think about commodities. They have the more liquid the commodity on the commodities market, the less the bid-ask spread. Whereas commodities that don't have a lot of liquidity, there's a big spread and you need to wait in order to find somebody, and it takes time to find a counterparty to your trade. So this is very helpful framework for understanding what emerges as money and helps us explain fiat. Why? Because all goods have a diminishing marginal utility. One very important concept in economics is diminishing marginal utility. The more you have of something, the less valuable the next unit of that something is. So the more you have of something, the lower you value the next extra unit that you get of it. So your first cup of water in the day is the most valuable. It's much more valuable than your 20th. So if you bring a large quantity of goods to the market, the buyer's utility from increasing quantities of the good declines. All goods have a diminishing marginal utility. So as you start bringing in more and more of that good into the market, you are exhausting the buyers. You're giving all the buyers more of that good. And so all the people who have a high valuation of that good are getting satisfied. And then you're ending up with the next potential buyer, the next marginal buyer, having a progressively lower valuation of the good. So therefore, as you bring more goods onto the market, you have to drop the price in order to tempt people who have a relatively low valuation of the good to pay for it. This similarly applies to traders buying the good to resell it. The more their stockpiles grow, the more they would offer for the marginal unit added to the stockpiles. As you need more buyers to buy, you need buyers with a lower marginal valuation who offer a lower bid, increasing the spread between bid and ask. So when you bring more of the good onto the market, what you do is that you satisfy more of the potential buyers and therefore increase the gap between the price that the marginal payer is willing to pay and the price that the seller accepts. So as a seller, you are hurt from the fact that more of this good comes onto the market. So the salability really is the degree to which the good does not lose value as it is brought to market by its owner. In other words, it is the ability of the good to maintain a small bid to ask spread as people bring it onto the market because of the fact that there is a very liquid market. The more that the spread remains small as more people bring onto the market, the more suitable something is for money because the more saleable it is. So a highly saleable good is a good that can be reliably sold at very close to market price. So you can, if you have a highly saleable good, you know when you have it, you can take it to the market and you know that the price that you're going to get for it is always going to be very close to the expected price that is very narrow range between the bid and the ask. That's what happens if you have a highly saleable good. So think about a gold coin or a $100 bill or something that is extremely liquid that everybody uses and everybody buys, that you can sell and buy very easily. So for instance, cars are a little bit more saleable than houses because it's easier to find somebody to take a car than it is with houses. So a good with low salability will lose significant value or require plenty of time to be sold. So think about, artwork, for instance, usually has relatively low salability because it has a very high bid to ask spread because if you need to liquidate a painting at a particular time, it's not going to be straightforward to find the person who's going to value it as much as you do and pay the price that you would get if you had time to liquidate it. If you were willing to wait for several months to advertise it properly and put it in the right auctions, you'd get a much better price than if you tried to sell immediately. That's a good with a low salability, with a very high bid to ask price, because the number of people that can afford a specific amount of fine art is very small, and the entire market is very small, and these people are always distracting by buying all kinds of different things. It's not as liquid as something like a car, or particularly a popular car like a Toyota or a Honda, which will always find people looking to buy it. There's a very big market for it. So the depth of the market really determines the salability of a good. A highly saleable good can be sold at very close to market price reliably. A good with low salability will lose significant value or require plenty of time to be sold, so that will involve extra costs.
The Bitcoin Standard podcast is brought to you by thesafehouse.com, my independent publisher and bookshop, selling the best Bitcoin books in high-quality cloth hardcovers built to last for generations. Most books these days are pretty fiat. They're flimsy and they fall apart quickly, and I did not want that for my books, so I set up the Safe House especially to provide you with beautiful, long-lasting classic cloth hardcovers you can proudly pass down for generations. You can get copies of my 3 books, The Bitcoin Standard, The Fiat Standard, and Principles of Economics, and you can also get copies of Lynn Alden's Broken Money, Parker Lewis's Gradually Then Suddenly, and Matthew Lysiak's Fiat Food, to which I contributed a few chapters, and Mexican billionaires Ricardo Salinas Pliego's new book, The Bitcoin Enlightenment. We now offer bulk discounts so you can buy books for yourself and for the friends and family you'd like to learn about Bitcoin. Buy any 2 books for $50, any 5 books or more for $20 per book, and for more than 50 books, it's only $15 per book. Go to thesafehouse.com, the SAIF house.com, where you can get all of these books in high-quality cloth hardcovers, delivered worldwide, and get 10% off for paying with Bitcoin. The Bitcoin Standard podcast is brought to you by the Daylight Computer. I love to work early in the morning and late at night, or in the sun outdoors, but regular computer screens are terrible at these times, and they strain your eyes. For years, I've wanted a paper-like electronic screen on a simple computer I could use to write. I tried several models, but none were very good. Now, finally, Daylight have delivered a fantastic full-function tablet with a paper-like screen that's easy on your eyes and great for outdoor use. I've been using the Daylight Computer to write my next book, and it is absolutely fantastic, and it has led me to invest in this company myself. Check out my interview with Anjan Kata in episode 249.
So we can assess salability across 3 different axes, as we discussed in the Bitcoin Standard: salability across time, salability across scales, and salability across space. Salability across time refers to how much a good loses value as it's held across time. Salability across time was the central analytical framework of the Bitcoin Standard. The good with the highest stock-to-flow ratio will be accumulated the most as a store of value and will face the least diminishing marginal demand as its quantities increase. So this is how I think of what becomes money. It's not a choice, as we discussed extensively. It's not a choice of what the government determines. What ends up being used across as money is primarily about salability, and primarily about salability across time. And that's why, in the Bitcoin Standard, the whole focus is on the stock-to-flow ratio, because it's the best way of thinking about salability across time. Because the good with the highest stock-to-flow ratio will have the least inflation of its supply over time, and therefore it will be accumulated the most as a store of value, and therefore will face the least diminishing marginal demand as its quantities increase. This is the key thing. Since it is used as a store of value and it is used as a medium of exchange, money is the thing that has the least diminishing marginal utility. This is, I think, a point to keep in mind about money, that money's marginal utility declines, but it declines less than everything else, because the first dollar that you earn is much more valuable for you than the dollar that you earn when you go from 1 billion to $1,000,000,001 net worth. The diminishing marginal utility of money declines because, the diminishing marginal utility of everything declines, but the diminishing marginal utility of money declines less than everything else because money can be exchanged for everything else. And because it has the least bid spread ask, it's something that everybody wants to hold. And that comes from the stock to flow ratio. That comes from the fact that it can't be inflated. Because it can't be inflated, because nobody can increase more and more of the supply, it will hold the value the best. And so over time, the value that is held in it will increase. And so cash balances in it will increase. So people will have more and more cash balances in it, either because they realize that this is going to hold value better, or just because people who end up holding other kinds of value storage devices, inferior monies, will end up witnessing their wealth disappear, so that the real wealth is only going to be accumulated with people who use the hardest monies. So the good with the hardest supply growth, the good with the highest stock to flow ratio, will continue to accumulate more and more cash balances. More and more people will hold more and more of it. And therefore, because people hold more of it, the quantity that people hold will increase enormously past the demand that they have for this good as a market good. In other words, the demand for gold exceeds the demand for gold as money exceeds massively, adds on to the demand for gold as an industrial metal or as jewelry. And so it becomes responsible for the price of it. And as a result of it, the market for the monetary side of the metal becomes a very important market in which everybody is effectively participating, because everybody wants to hold this metal. And it continues to hold more and more value. So the value that's held in it increases. And all of that leads to the bid and ask spread declining. And so therefore, because people have a lot of balances, when you're trying to sell something to somebody or you're trying to buy something from somebody, they're more likely to want to take this thing because their balances in that thing continue to grow. And so as balances continue to grow over time because of the appreciation from the hardness, then we get less and less diminishing marginal demand as its quantities decrease. People will hold the money because they know that they can exchange it. So it's a cycle that reinforces itself. It holds value well because its supply can't be increased. So then the amount of value that is held in it increases. Because the value that is held in it increases, the liquidity on the market increases, the bid and ask spread declines. People are likely to trade it easily, and so that makes it more liquid. So that gives people even more of an incentive to hold cash balances in it, which brings the price up, which keeps the value going up. And then that basically is how money emerges on the free market. With all other goods, you value the good because of its own marginal utility of how you use it. You buy apples and oranges and cars and houses because of how much you value their consumption, consuming those things, getting to use them and enjoy them. But with money, you value it based on the marginal utility of the next thing that you can buy with it. So gold's high stock to flow ratio and its resistance to debasement mean that people don't value it only for its own use and marginal utility, or as an ornament or as an industrial metal, but as something that can be exchanged for other goods. So market participants are happy to accumulate gold more than anything else because they expect to be able to resell it for the least loss of value in the future, given its resistance of dilution. Over time, this is the best thing to accumulate, as it is the thing that can be exchanged most easily to other things in the future. So this is how we can think about salability across time. Now, in terms of salability across space, salability across scales, Salability across space refers to how much of a good loses in value as you transact across scales, as you move from small quantities to large quantities. If you wanted to sell small quantities of gold to make a small purchase, you would incur significant loss chopping off small pieces and weighing them. So historically, silver maintained a monetary role as gold was not highly saleable across small scales, and as banking allowed for the use of banknotes and checks across all transaction sizes, silver's monetary role was obviated, and silver has never recovered. So this is the story of salability across scales, which is also mentioned in the Bitcoin Standard. And it helps us understand why silver has lost its monetary role, because once banking allowed for gold to be divisible across scales and groupable, then you didn't really need silver anymore. And then gold just became the only money. And then we think about salability across space, how much a good loses in its value as it is transported across space. So these are the three facets of salability. Money is a way of moving value across time and across space. Moving it across time, you want a higher stock to flow ratio. For moving it across scales, you want something that's easy to divide and chop up and combine into pieces, so it's all fungible with one another. And then for moving for space, you want something that can move quickly and cheaply. If you have to spend a lot of time and money on moving something from point A to point B, then it has low spatial salability. It has low salability across space. The cost, when you bring it to market across space, when you want to move it across space, the spread between the bid and ask has to spread because there's a big friction in the middle. And so salability across space helps us understand why metals beat cattle and crops, because metals are smaller and can carry value in smaller volumes and weights, and so therefore they're very easy and useful to move things around. And it also helps us understand why gold beat other metals, why gold is better than other metals as money, because it is the one that's most valuable, because it contains more value per unit of weight, and so it's the one that's cheaper and easiest to move around for long distances. Standardizing metals, monetary metals, into coins increased their salability across space by making the coins immediately recognizable. But the invention of modern transportation made gold's salability across space decline. Effectively, gold stopped being the fastest, cheapest way of moving things around when things started moving faster than gold. When you can move goods much faster than gold, because gold, needs to be secured. So you can move agricultural produce across the Atlantic. And because there's a lot of security involved in moving gold and clearing it and ensuring that it is done in the right hands, it could be traveling even slower than the agricultural commodities that move across the Atlantic. So the more that the global trade depended on more and more transportation, the more that fossil fuels revolutionized the way that we transport and move things around the world, the more gold's salability across space became as an obvious limitation. Gold became very expensive relatively to move around. And banking as an industry fixed this through the resort to the systems of clearance and settlements, which is how fiat functions, wherein you don't have to move gold around every time you make a transportation. You pay by check or by bank transfer, and the money moves effectively on balance sheet entries. So your bank is debited by the central bank, and then the central bank credits the bank of the recipient, and the bank of the recipient then credits the recipient. So with that, then at the end of the day or week or month, both banks settle with the central bank, and very few physical movements of gold are needed for every transaction that takes place. So the transactions are tallied at the end of the day or week or month, and then at the end of the day or week or month, the physical movement of gold would happen. And this obviously increased the efficiency of gold and the salability of gold enormously across space. But of course, it compromised the way that the system of the gold standard worked, because it gave the people who ran these credit facilities the ability effectively to create money by fiat. So with time, as people took physical delivery less and less because they needed their money on the payment rails, money increasingly became a liability of the financial institutions settling payments. Although banks could honor their promises to redeem any of their obligations for gold, they could issue more gold liabilities than the gold they had on hand, thanks to its limited spatial salability. There was no easy and convenient place for bank clients to redeem their gold and still use it for settling the increasingly global trades they conducted. With only one monopoly bank in a town or one central bank in a country, your gold coin had very little spatial salability while it was in your physical possession. In other words, the inadequacy of gold's salability across space is what required trust in banks and central banks, and what allowed these institutions to monopolize the system for banking and clearance and saving and international transfer in a way that allowed them to effectively increase their financial power and increase the money supply. Effectively, they could issue more liabilities than they had gold on hand, because they knew that the people who had their gold with them needed the gold to stay with them. They couldn't just take the gold out because they needed the gold, to send it and receive it all over the world. And for trade, they needed to keep it there. So more and more gold stayed there. So they had a large margin for engaging in monetary shenanigans because they weren't getting called out. So the gold standards, really, I think a useful way of thinking about it in trying to understand how fiat came along is that the gold standard's monetary medium was not just the gold underlying it, but also the payment and settlement rails that allowed it sufficient spatial salability to move around the world. This is the thing. Like, once you understand that gold needs to be moving around very quickly in order to function as money, then the money is not just the yellow metal. The money is the yellow metal and the rails that allow it to move around. The system of banks and central banks and the system of clearance, where they have clear protocols and mechanisms for moving bars of gold around and accepting them and verifying their accuracy and debiting and crediting each other's payments, that was necessary to make gold function as money. And therefore, the supply of gold was not the only part of the monetary infrastructure, of the monetary network, of the monetary premium that is involved. Gold in the bank effectively carried a spatial salability premium over gold in individual physical possession. This is, I think, a key point to keep in mind. When you have your gold in your physical possession, you're unable to move it around because it has very low spatial salability. You have to move it around with yourself physically, or you have to give it to somebody to move it around. That's extremely expensive, as opposed to just putting it in the fiat banking system, or, well, it wasn't even fiat then, as opposed to putting it in the gold standard banking system, wherein the gold had wings, basically, because you could just call your bank and then the money would be in China in a few days. So there was a huge premium for keeping the gold coins in the banking system. And that's what allowed the banking system to effectively make more gold than the gold that they have on hand, or issue more liabilities for the gold that they have on hand than they had gold. So although gold is highly saleable across time, its salability across space is very low compared to fiat. This is as significant a flaw as having a low stock-to-flow ratio. I think this is really, the point where gold bugs need to come to terms with loss of monetary status. Having high salability across time is great, but you also need high salability across space, and the inability of gold to move and hold value across space is the flaw that allows it to be centralized and captured by government. And this is as significant a flaw as having a low stock-to-flow ratio. Whereas a low stock-to-flow ratio leads to a loss in value when trading the good across time, a high cost of transportation results in a significant loss of value when transacting the good across space. So a hard money that requires brick and mortar banks in order to clear is always liable to government seizure or being replaced with government fiat. Political and engineering realities mean that the low spatial salability of gold and physical monies needs to be considered a feature, not a bug. This is just how physical money works. It's going to have to require extensive physical infrastructure, and that's going to fall into the hands of government. Government are going to want to have control over that because they have the guns and they always want more money. So it's just, it's an unsustainable arrangement, to put the coyote in charge of the sheep and hope that the sheep continue to graze peacefully. It's not going to happen. You can point to government restrictions on the free movement of gold as a reason for fiat's rise, but that misses the point. If gold had high salability across space, it would not need governments to ensure its monetary role. You could just move it around regardless of what governments want. So how can we think about gold's spatial salability? I'd like to try and quantify it using the cost of moving a good delivery gold bar across the Atlantic. So these good delivery gold bars that you see in the graphic here, they're, this photo here it says 1 kilo, but I don't think this is a 1 kilo bar. This is usually a 12 kilogram bar. The 12 kilogram bar is about the size of it's about the size of a shoebox, roughly, a little smaller than a shoebox, and it's 12.5 kilograms, which is around 400 ounces of gold. Currently, at current prices, that's worth something in the range of around $700,000. So it's $700,000 for one of these big yellow bricks. That's how central banks and large financial institutions used to settle with one another in in the gold standard financial system. So you get to use your local bank for dealing with other banks and other people in other countries. And at the end of the day or month or year, the banks and the central banks would settle their accounts with one another using these large gold bars for all outstanding trade and debt. You thinking of the cost of moving this across the Atlantic, I think, is a useful way of trying to understand the salability of gold and compare it to fiat and Bitcoin. So In 1919, based on data from John Osborne's book, which we'd mentioned in chapter 2, on how the Bank of England managed the finances during the war, they sent a lot of gold bars to the US. And based on the costs of that, we can see that it cost around 0.2% of face value. So the face value of the gold, you would pay about 0.2% of it to move the gold across the Atlantic. A sunk boat, this was one problem here, is that a sunk boat could cost 2 to 3% of face value to salvage. You'd have to pay something like 3% to get your gold transaction unstuck in the Atlantic pool, basically, to use Bitcoin terminology. This is what it was like in 1919. In 2003 or 2017, we know that the German central bank wanted to repatriate its gold from the US Federal Reserve, and it cost them around 0.05 to 0.1% of the face value of their gold to move their gold from the US Fed to Germany. So it's about 1,000th of this. But that process took around 4 years. It takes around 1 to 2 weeks just to ship the gold, just to physically move the gold. But in order to do everything and, process the whole thing and verify it and complete the movement with verification, it took around 4 years to complete that. Today, moving a single gold bar across the Atlantic costs around 0.5% of the cost of the gold bar and takes around 2 to 3 days. That means that in its lifetime, a gold bar will pay for 200 trips across the Atlantic. You can have a gold bar and you can move it across the Atlantic 200 times, and the cost of moving it across the Atlantic 200 times is going to be a whole gold bar, and 2 to 3 days every single time.
This podcast is also brought to you by the Bitcoin Way, your professional Bitcoin IT team offering you personalized, secure, and comprehensive solutions for every step along your Bitcoin journey. The Bitcoin Way offer live concierge service to guide you with your Bitcoin cold storage, running your node, privacy best practices, inheritance planning, corporate strategy, and multi-sig solutions. They don't touch your coins, they guide you through the process of acquiring your coins and securing them. If you'd like to make your setup safer and more reliable, book a consult with them and see what they have to suggest. If you want to give someone the gift of Bitcoin, get them this professional service that will ensure they start off knowing exactly how to manage their coins and not lose them. Go to thebitcoinway.com and start Bitcoining more confidently.
So, obviously, fiat is far, far cheaper to move across the Atlantic. You're only moving credit obligations, nothing physical. So, a wire transfer, if you're sending a small amount of money, it costs around $10 to $50. It takes around 2 to 5 days for consumers. If you're sending a small amount of money, but also even if you're sending a large amount of money, that's the cost. So, if you have $100 million in a bank account and you want to send them to somebody at another country with another bank account, you're also going to be paying something like that. That's how you get to move fiat across the Atlantic. So you could do it with $10 to $50 depending on your bank. It can take 2 to 5 days to arrive depending on the countries and the banks. If you try and do it with credit cards, it'll be 1 to 3% of face value, and that takes seconds. But that's, of course, just a payment. You're moving a credit obligation. This isn't final settlement. It takes weeks or months for both cases to get final settlement. So in other words, fiat is faster than gold in moving the credit liability, in moving credit, because it's a payment system that's optimized for trying to move things around the world quickly. But that can't offer you final settlement. Final settlement requires moving physical stuff, or it requires settlement between all these layers of financial institutions that are involved. So you have your bank, and then their correspondent bank, and their central bank, and then the recipient's bank, and their correspondent bank, and their central bank, and a lot of regulatory agencies that have oversight. So in order for everybody to do their song and dance, in order for you to move your money around, it takes quite a bit of time. So in terms of final settlement, fiat is actually slower than gold for final settlement, but it is faster for just moving liabilities. But as gold standard payments increasingly became credit payments and not cash settlements, the payment rails of banks and central banks became an increasingly important part of the monetary infrastructure that made payments possible. And that we can think of as the Faustian bargain of fiat money. It appears inevitable, really, as the ability to save for the future was compromised to transact quickly across space. We gave up our ability to save with gold and to provide for our future in order to get to trade quickly across space, in order to get to move money around quickly and use central banks as payment rails. The technology of fiat strongly benefits governments and banks, but it was the spatial salability of fiat that allowed them to take advantage of it to their own ends. It's really the spatial salability of fiat that is the technical edge that allows it to function. Now, the second part of this lecture is on the profitability of banking. So that's, I think, the other killer app of the Fiat Standard. Fiat allows banks to engage in fractional reserve banking with little restraint because it allows government to bail them out whenever they face liquidity, or in other words, solvency crises. A fiat misconception is the idea that there is a difference between liquidity and solvency, that if you can be solvent but illiquid. But from the Austrian perspective, and I think in the Bitcoin world, and that's what, I think the two are congruent, there is no distinction. Either you have the private keys and can move the coins with the next block that's going to have transactions on the Bitcoin network, in which case you're liquid and solvent, or you don't have the private keys that can move the coins at this particular block height, which means you're illiquid and insolvent. That's the beautiful thing about how Bitcoin functions. Every 10 minutes we have a check on everyone's solvency and liquidity. Every 10 minutes there's an agreement between everybody on the network on who owns what. Everybody agrees these addresses have this many Bitcoins and these keys have that many Bitcoin. Under the gold standard, banks could still engage in fractional reserve banking because they provided gold with superior salability. I think this is the key thing, that gold limits fractional reserve banking but doesn't eliminate it completely, because when you're using gold, you rely on the banks so much because they're the only ones that are able to move your gold around, that they can do all kinds of shenanigans with your gold, and you have no choice but to keep your gold there, because if you take it out, your gold is an immobile yellow rock, and you can't use it for trading with people unless you meet them in person, which becomes increasingly impractical as the world becomes more and more intertwined and technologically advanced and specialized, and the division of labor grows and industrial technology advances. But under the gold standard, bank runs and the ability to engage in fractional reserve banking, while fractional reserve banking was limited by bank runs, because you could get around with issuing a little bit more liabilities, but of course, the more you issued, the more confident you became in your ability to issue more, the more you issued, and then eventually you got called out. And then eventually you found yourself illiquid or insolvent, and therefore you needed a bailout. But under the gold standard, nobody could just print gold and bail you out. You had to borrow on the market, and if you couldn't get a lender on the market to lend to you because you're insolvent, or illiquid if you prefer to call it illiquid, well, then you got out of business, and then nobody gave you credit and you went out of business and you got liquidated. So banks could do this stuff, and they did do it, and they did occasionally and habitually, not occasionally, they did periodically and habitually get into crises when they tried this stuff. And the result was, over time, the more the banks did this stuff, the worse things got. Now, what was always allowing this to continue was always governmental intervention. So it's not like the 19th century was some libertarian utopia where the government wasn't there. There was nominally a gold standard, but government still intervened a lot in the money supply. They tried to make silver money in the 1870s to the 1890s, and that failed horribly. They, I would think it was in the 1890s, and they printed a lot of money during the Civil War in the US, for instance. And there were all kinds of things that they did and intervened with the banking system in order to bail out banks and give banks monopoly licenses that allowed them to engage in credit expansion because they didn't face competition. But effectively, they were still limited because governments could do a lot. They could give them monopolies, they could do this and this and that, but they couldn't print gold. It was what restricted them. And then getting rid of the gold standard and moving on to the fiat standard was what allowed fractional reserve banking and modern fiat banking to prosper. So in 1913, the Federal Reserve Act was passed as a response to the financial crisis of 1907. Now, this way, governments could stabilize the financial system when panics happen. That was the idea. The Fed was not the cure to the disease of insolvent banks. Insolvency was the cure, and the Fed was the antidote to the cure. The idea here was that governments could stabilize the financial system when panics happen, but in reality, the Fed was not the cure. The cure to insolvent banking and fractional reserve banking is liquidation and people learning their lesson, and people who did these things not having any money left to do it again and having to start from scratch doing something for an honest living. But what creating the Federal Reserve did was that it allowed this business model to become enormously successful, because when you do it, you either profit and make money, or you lose, in which case you effectively get bailed out by the Federal Reserve to prevent a financial crisis, which effectively allows you to carry on doing this over and over and over again. So the Fed's rationale was, let's stabilize the dollar and protect the banking system from bank runs and financial crises. But these goals are, of course, contradictory, as Friedrich Hayek explains. You can only protect the banks from bank runs by printing money, which destroys the value of the dollar. So you can't give somebody the, it's like saying your mission is to protect this cake and eat it. No, you can't. You either protect the cake or you eat it. If you eat it, there's no more cake. If you protect it, you can't eat it. And similarly, the Fed can either stabilize the dollar or protect the banking system. If it protects the banking system, it needs to print more dollar, which is going to destabilize the dollar and reduce its price. And so here we are 1 century later. What has happened to the value of the dollar? It is an infinitely tiny fraction of what it was back then. It's less than 1% of where it was in 1914. Because the way that this has unfolded is that the money was destroyed to save banks. The money was constantly inflated to allow banks to engage in inflation. And here we get into an important debate on whether fractional reserve banking is necessary for an economy to grow. The short answer is no, and you have to be a Keynesian to believe so. And there's a lot of references in the chapter of the book where you can see a detailed discussion of why this is the case. There's a long debate on this within economics, within Austrian economics and Austrian and people who are close to Austrian economics, perhaps not entirely Austrian. But I think the Rothbardian view and my view on this is that money and credit by themselves are not productive assets. In the Misesian view, they merely represent receipts that allow their holders to purchase productive assets. An increase in the supply of money or credit will no more increase the stock of productive assets in an economy than an increase in printed football stadium tickets will increase the capacity of the stadium itself. So the idea that we need fractional reserve banking because it allows banks to create more credit is completely misguided Keynesian thinking, because again, it thinks of the credit itself as being the productive asset. But all that the credit does is that it reallocates the already existing assets. You don't make more seats in the stadium by issuing more tickets. You just create more people fighting over the same number of seats that already exists. So fractional reserve banking does not magically create more capital, labor, or resources. It merely entrusts their allocation to central banks rather than the productive, conscientious people who produce and save them. Fiat central banking is what makes fractional reserve banking viable. This is really the key idea. And we'd have a very different world. But of course, today, the real fractional reserve banking is not really done with commercial banks, with your deposits, with your checking account. Retail banking has been effectively separated from investment banking in the 1930s. And what we have now, the fractional reserve banking is happening in what is called the shadow banking system, or the investment banking. The distinction between the two was that retail banking would be tightly regulated. The government would very strictly regulate banks and how they can issue credit and who can get credit. And it would have FDIC insurance. The Federal Deposit Insurance Company is a company that is provided, that has a line of credit from the Federal Reserve, and it can insure the deposits of all banks. And this is the reason why, no matter what happens, people's checking accounts are protected, and they have been for almost 90 years in the US, pretty much protected in this regard, that whatever happens, in the world, your saving account, your checking account, up to, I think it is $200,000, something in that range, that is protected by government insurance. The cost for that protection is the governments will heavily regulate how the bank is able to lend. So this is why we don't see a lot of big financial crises in commercial lending, in retail banking, I mean. But we see all of the crazy fireworks happen in the investment banking part of the industry, which was supposed to function in a way where they don't have FDIC insurance. And so if they do engage in monetary shenanigans, it's on them and whoever wants to invest with them. Your mom and pop shops, checking and saving accounts are going to be safe because the government guarantees the retail banks that are dealing with them. Separating the industry into these two parts was the way in which the Fiat Standard reacted to the fact that the problem of saving in fiat became a big problem, because before, you could just hold gold. But then when fiat was money, people started putting their money in the banks, and then the banks started engaging in fractional reserve lending, and there was inflation taking place. So the value of the money in the banks would collapse. And some of the banks would collapse, which is what happened in the 1930s. So all of that put together is a big problem for the retail banking industry and for people's ability to save. And so effectively, government regulation tried to protect ability to save by keeping retail banking separated from all these other kinds of commercial banking, all these other kinds of investment banking. And that, investment banking would be carried out with people's money when people want to take a risk, knowing that there is a risk. But of course, as time progressed and as fiat became more entrenched, the line between the two was blurred. Now, the shadow banking system is also engaged in fractional reserve banking, and it has managed to get a lender of last resort to bail it out, the Fed. And in this chapter, I have a detailed discussion of how this has happened over time. There's an interesting book called Too Big to Fail that discusses this. And, up until the 1980s, more or less, this kind of arrangement had held that you could keep your money in a bank account and the hedge funds and the investment banks would go out and do crazy things. They would lose or they would make money, but that would be on them. Then in the 1980s, Alan Greenspan came into the Federal Reserve, and that's when things began to change. So first of all, they did the low interest rates, which was effectively a subsidy for the shadow banking system that allowed them to go ahead and create a lot more credit. And then secondly, we developed this conception of this thing called too big to fail, where suddenly financial institutions, even though they formally do not have a guarantee from the government or any kind of protection from the government that should protect them, they suddenly just effectively declare themselves as being too big to fail, and therefore they can't fail. And then it's the central bank needs to step in, because if they fail, then things are then they have too much contagion. They will affect the financial system too much. Obviously, the correct way to deal with a financial firm that is too big to fail is to let it to fail, because if you keep it alive, then you continue to make it bigger, and then when it fails, it's even worse. So nothing should be too big to fail. Everything should be prone to failure. That's why everything should be robust, because everything is always succeeding to not fail. You know that everything is not propped up with duct tape and tree twigs, because everything that can fail will fail. And so you're always dealing with things that survive failure. When you make it so that some things are too big to fail, then you get rid of that. And then there was Greenspan's put, wherein Greenspan basically told the financial industry that, hey, listen, if push comes to shove, don't worry, we got you. We can lower interest rates to make sure the financial industry doesn't get into trouble. And then, of course, favorable regulation and the repeal of the Glass-Steagall Act, which allowed commercial banks to then get into this giant mess, which created the financial crisis in 2008. The conclusion from all of this, and there's more detail in the book, but the conclusion is that the vast majority of money is today created by the shadow financial system. It is credit creation without a formal lender of last resort and little regulatory oversight. So the money is constantly being created from this shadow banking system that is not accountable to taxpayers. Even if you want to believe in these things, it's not like there's any kind of oversight here. They kind of have the Federal Reserve and the U.S. government as their hostage, if you want to look at it in a certain sense, in that they've grown to a size where they're too big, and they have built-in institutional mechanisms that are constantly there to support them to continue to get bigger. And they're out there just making more and more money. So They're out there just generating more money, not just profiting as an industry, but also increasing the money supply. And that's where the vast majority of money creation is taking place these days. And so clearly this kind of fiat monetary system works very well for the banking system, works very well for the financial industry. And these really are the reasons for fiat's continued growth and success. It's great for moving things around quickly, but it's also great for government spending, and it's also very great for banks to be able to engage in all kinds of fractional reserve banking shenanigans. And that is it for this lecture. Thank you.